Retiring early can be a rewarding venture, but without proper planning, it can present many challenges. Whether it's waiting to access retirement accounts, dealing with more complex tax situations, or simply having the need for your money to last longer due to a longer retirement. If we haven't met yet, I'm Kyle Kuyat, certified financial planner and co-founder of Defining Wealth. And in today's video, we're going to walk you through a case study of how we helped a client retire early and do so with confidence. Also, if you want to test the tool out for yourself that we use in this video completely for free, check it out in the description below.
Today, we are talking about James and Madeline Sample. So James and Madeline came to us. They're both 49, turning 50 this year, and they are 5 years away from their desired retirement date. So we have a lot to work on with them. We wanted to take you guys through this live example of what we did to take them from unsure about their retirement and kind of a low confidence level on what they were doing, what their direction was, and ultimately adjusting some of the things that could make them a lot more successful going forward. James and Madeline are 49, turning 50 this year. They've got two kids, Lucy and Liam. If we go over here, they've got $120,000 in the bank. That's a pretty solid amount. It actually covers what we would say is a reasonable emergency fund for them. So we felt pretty good about that. We're going to leave it where it's at. They have 401ks. So Madeline just started a new position this year. She went back to work and she has a 401k that she has access to now. James has been contributing to a 401k for quite some time, but they were focused on funding these 529 accounts that you see down here for quite a while, and don't necessarily have all the assets built up in the 401k that you would typically see here. They have an $800,000 home that they purchased for $500,000 a few years back. They pay some property taxes on it, and we'll talk a little bit about too, like what does it look like to downsize in retirement if they were to do that at some point. Again, that's not going to be the number one thing we talk about with them, but it is something on their radar that we'll pay attention to. They have a $300,000 home loan that started at $350 in 2020, a 4.2% interest rate, and an $1,800 monthly payment. So they're getting ready to retire, and part of that is going to be talking about, do we pay off the mortgage before we actually get to that point? Do we try to downsize after the kids are gone? What are the things we're going to do there? So James and Madeline are currently making $230,000 and $120,000 respectively. You'll see here, James has consulting income. This is actually going to be after he retires. One of the things he's considering is consulting for his current work. They're open to that arrangement. So we have him consulting for 5 years after retirement. They've done it before, and it's something he's interested in doing for them after walking away from full-time employment. And then Social Security, we're just using estimate here. So based on their income, what they've made, we're using the estimate at full retirement age for them at this point. But more importantly, we're looking at their goals, right? And what are the things that are important to them? This is always a conversation we have with our clients right up front, is what's important to you with your money and what are we actually trying to accomplish? So like we said, one of those goals is walking away from full-time work at age 55, and that's for both of them. So they have about 5 years left of good full-time hard work until they can pull the ripcord and go away from full-time employment. At that time, they want to spend about $8,000 a month throughout their retirement. We assume that this goes up over time with a 3% inflation rate. And because they're retiring early, they're going to have $1,000 a month of health insurance costs. Now, that's a little bit of an estimate. They have kids right now. They won't have dependents on their health insurance necessarily all the way up until they're age 65 when Medicare kicks in. So we're going to estimate at $1,000 a month for now. Another thing they said was very important to them was annual family vacations. So whatever way, shape, or form that takes place, for the next 20 years, they want to do $10,000 a year in family vacations with their kids. And then, of course, we're not going to talk too much about this today, but they do want to send their kids to college. That's what the 529 savings were for. And quite frankly, a little bit of the reason why they're kind of behind on retirement savings so far.
So like a lot of people, Jim and Madeline know what they want to do, which is retire early. However, the challenge they had when they came to us was how to put all of the pieces in their financial life together. Although they did a pretty good job saving money, spending money in retirement left them with more questions than answers. Let's talk about how we helped them figure that out.
So when we met with James and Madeline and put this plan in front of them, we kind of told them first, like, don't freak out at the 22% probability of success that you see on the screen. That's not the end all be all. It's just if we don't change course, what is our confidence level in this plan working out? And for them, it was, hey, we have some work to do. We have some things we need to work on. So what we do is we take our clients through a dynamic, collaborative trade-off conversation. And so for them, you can see all of their current plan details right here. We've got them retiring at age 55. They want to spend $8,000 a month. They're going to need $12,000 a year for health insurance, and they want to spend $10,000 a year on family vacations. James is going to make this $100,000 a month. They're currently maxing out 401ks, and again, catching up a little bit on the savings side of things. So they're maxing out these 401ks, and they are spending $12,000 a month right now with the kids at home. One of the things we talk about first is, again, what's important to you? What's the highest on the priority level? So there are different levers we can pull. Like if making work optional at 55 is the most important thing, then we're not going to mess with that variable. For them, we wanted to show them a lot of options. So we'll run through some of those today. For most people, there's some level of prioritization that takes place. Like, is making work optional at 55 number one and you're willing to spend less? Or are there certain goals that could fall off, like they're nice to haves and not need to haves? All of that's part of the conversation, and all of those are levers that we can pull here. One thing that we talked to them about is their current asset allocation is a moderate investment allocation. So if we go over here, you're going to see that basically a 60-40 portfolio is going to mean that they have no money left in at the end of the plan. Again, there was a low confidence level that this plan would work if we made zero adjustments. So we told them, hey, if we pull that lever and we say, all right, let's put them in an 80% equity, 20% fixed income portfolio that we manage based on our own assumptions. How does that help? You can see that this gets us to age 87 with the invested assets, but doesn't necessarily solve the problem of running out of money at some point in retirement. So not the ideal scenario there, and something that we certainly need to do a little more work on.
There's a lot of decisions that Jim and Madeline can make, but they wanted to make sure that they were making the right ones. Anytime we help clients make financial decisions, we want to make sure that we're including more than just risk and reward. And anytime you make a financial decision, make sure you run it through this filter. In addition to risk and reward, there's also your timeline, meaning how long and when do we need to be able to spend this money, tax implications both today and in the future, as well as cost, whether that be actual cost or opportunity cost of said financial decision. Clearly, every financial decision involves trade-offs. Let's walk through the pros and cons and how we help Jim and Madeline evaluate their options.
The other thing we can look at with James is he's not entirely married to age 55. He wanted to see what that would look like to walk away early at age 55. But let's say that he works an extra 2 years and retires at age 57 instead. So if he does that, you can see the huge difference that makes from a end assets in the plan. This is money that you can take more vacations with. You can be, frankly, sleep at night in retirement with. You can give to your kids. You can help your grandkids out with. That's what he wanted to see. But let's just say this is so much better than retiring at 55. Let's say it's 56 and he works just one more year. You can see there also a big effect. Now, keep in mind what's happening with this 1 year. It's not just that he's working one more year and making one more year of income. He's working one more year. He's maxing out his 401k. He's avoiding paying for health insurance out of pocket. And he's extending the window for him to have part-time income as well, because he's going to work for 5 years after he retires at this $100,000 a year. That pushes that window out as well. It gives him the ability to have more flexibility in this plan when there's more assets invested throughout retirement. Now, while all that's the case, that if he works for one more year, it gets substantially better. Let's say he doesn't work that extra year, and instead they say, hey, that's all well and good. We could actually spend $6,000 a month in retirement and feel pretty good about that, as long as we can do all these other things with family vacations, helping out our kids, being around, having fun, right? You can see the substantial difference that makes, because again, they are going to retire at 55 and spend $6,000 a month instead of $8,000. That's going to be happening for the next 35 years. So even a small change in the amount that you spend after taxes can make a really, really substantial difference when it comes to the success of your plan and how much you'll have invested in your portfolio. One thing to keep in mind as you retire early is there are things that become more complicated, at least before you're age 60 and 65. 65 being when Medicare kicks in and that's your health insurance going forward. And then before age 60, that's the retirement age when you can start taking money out of your accounts. So there are some things we got to talk about there. For James and Madeline, they have the taxable brokerage account that's going to continue to grow until they retire. and it gives them enough assets to live off of until they get to age 60. So they can avoid taking penalties, those 10% early withdrawal penalties on their 401ks before they're age 60. If they didn't have taxable brokerage accounts to draw from before they're age 60, there are a couple of things we can do. There are 72T distributions, which are substantially equal payments until they're age 60 or for 5 years or more. Or they can potentially, if their employer plans align with this, they can use the rule of 55, which means if you leave the funds in the 401k where you were working and retired from, if the plan allows it, you can take distributions from that 401k without penalty until you're age 60. Now, this does not mean you won't pay taxes on that distribution if it's pre-tax money. It just means we'll avoid that 10% penalty. The rule of 55 treats you as if you're at that retirement age if you leave the money in your employer plan and take it from there.
In most conversations, asset location is just as important as asset allocation. Being that we're at least 5 years out from when they want to retire early, there's a few different things that we discuss with them. We talk through the importance of having a brokerage account and the liquidity that that can provide, especially during an early retirement. Also, if they had been contributing to a Roth for a long time, it wouldn't be the first place that we would go. However, they could also access the basis that they had saved up.
Ultimately, for James and Madeline, what we landed on as the plan going forward is them both working for an additional year, spending $500 a month less throughout retirement with an 80% equity, 20% fixed income portfolio, and targeting still just working one more year, retiring at 56. And that gives us a 61% probability of success for all of retirement. 61% probability of success isn't the highest success rate. It's something that they were comfortable with because they know they can continue working if they really had to. This was a aspirational walk away at 55. For right now, we're going to target that 56-year-old age to walk away from work and have James do consulting. And if it continues to look better and better, we might push it back to 55. If the success rate is right here or starts to recede a little bit, they can make the decision to work another year and they're comfortable with that level of risk.
Thank you so much for watching. I really hope you enjoyed today's video. If you can, do us a big favor and click like. And if you enjoyed this video and want to see more like it, make sure you go ahead and click subscribe. Again, I'm Kyle Kuyat, and I will see you next time.